Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsarthi. And in this podcast, we are going to talk about why should the market expect 50 basis points rate hike from the RBI in their forthcoming policy meet in August, the bi-monthly policy meet. A lot of factors have changed in the last quarter since the June policy meet, where RBI kept rates on hold and did not change their stance. But they did announce a whole host of measures to make sure that there was volatility in the currency markets were lower. The government had announced capital gains relief for FIIs and FPIs to invest in government bonds, took away FAR limits. All that helped in bringing inflows into the debt market from FIIs. They have pumped in well over 1 lakh crores, rupees 1 lakh crores into the debt market in the last quarter up to as of date. Whereas in the equity markets, there's been outflows, and actually equity and debt they have negated each other, and net inflows into the country through the FPI route is almost zero. If you just look at the negative equity and positive debt inflows. Before we go into why the RBI should hike rates or will hike rates, or why should the market expect rate hikes in August, just to remind you, bond markets carry interest rate risk, where prices can go up and down, credit risk, risk of default, and the liquidity risk, where the impact cost of buying and selling can be very high. INR Bonds is a bond market platform of Zephyr Financial Publishers Private Limited, a registered SEBI registered stockbroker and an NSE registered OBPP. Um, yeah, now back to the question of why rate hikes. A few things the markets have to note and the listeners have to note here. One is since the time since April this year or March this year, there's been a lot of volatility in the currency markets due to the ongoing tensions in the U.S. Iran war, and that has affected a whole host of other things, including increased oil prices, etc. There was a brief ceasefire which stabilized markets to some extent. You saw during the heavy period of volatility, we saw the rupee, Indian rupee, actually falling very sharply to record lows of over rupees 97 to the dollar. And then there was coupled both with ceasefire as well as RBI announcing SOPs for the FIIs, and also the FCNRB SOPs for banks to collect more FCNRB deposits from NRIs. And those two put together helped stabilize the rupee levels. The Indian rupee strengthened from over 97 to the dollar to closer to around 94 to the dollar, rupees 94 to the dollar. But then they have not been able to maintain that stability. Again, there's fresh tensions in the Middle East with US and Iran. Oil prices are again shooting up. There's a lot of other tensions as well. And all that put together has also made sure that the currency, the Indian rupee, has gone back to closer to rupees 97 to the dollar. And this time, despite strong flows from FIs, FCNRB collections as of date, data, whatever published data is there, it's closer to $20 billion. But that's not really enough to stem the fall in currency, fall in the rupee against the dollar because of global issues in terms of global risk appetite, etc. And the RBI now we have seen that RBI has been selling US dollars to protect the rupee from a free fall. The FX reserves have fallen from $695 billion to closer to $675 billion. And also, RBI has been selling on the forward market. If you look at the net outstanding forward sales as of May, which is the last data available as of May 26, it's around USD $106 billion. So if you take off $675 billion less $106 billion, you're closer to something like $565 billion, 560 closer to $565 billion on the FX reserves now, which may not be enough, which brings down the external debt ratios as well, and import covers, etc. Given that higher oil prices necessarily increase the outflow of dollars. And we have also seen now, given the tensions, that exporters are holding back bringing the currency into the country, and also importers are actively hedging their on the forward markets for their import covers. Put together, then the differentials between the U.S. Treasury yields, which are now rising, the 10-year and the 30-year U.S. Treasury yields are at well over 4.5% and 5%, and that also is reducing the gap between the yield on the Indian government bond and the U.S. Treasuries. And this is also and so exporters are happy to keep their dollars in dollar in keep the dollars outside, as they do not suffer a very large negative carry by keeping dollars outside, because the differentials between the Indian repo rate and the um, US Treasury rates are not very high, right? So put together, there is definitely a weakness and a tendency to sell the rupee against the dollar, which is pushing it towards record lows. And given that it's at rupees 97 and the psychological mark of rupees 100 is very close, just about 3%. So RBI may want to now start to use interest rates to protect the rupee, and also make it costly for one is speculators to sell the to go along the dollar, short the rupee, and also tighten and also increase the spread differentials, so that exporters are are given are enthused to bring back their dollars into the Indian market to earn higher carry on their deposits, on their funds. So, given all this factors, RBI would at this time in August, despite the stance in June where they said the rate hikes are not imminent, I think RBI would have to start hiking rates. And if you look at the swap rates, interest rate swap rates, the 1 year swap is factoring in a minimum of 50 basis points rate hike at 605 levels. So given that, and also that 1 year treasury bill is at 575, the liquidity has come down sharply. At one point of time, it was well over rupees 4 lakh crores in the banking system. Now it is just below 50,000. It's hovering in a range below one rupees 1 lakh crores. So all put together, clearly everything points to tighter liquidity conditions, higher rates, short-end rates. The question is, markets will want to ask is whether 50 basis points will be enough to protect the rupee on a free fall. Now, but I think this time RBI will take it much more slower than what happened in about in the 2012-13 period, when because of the very sharp fall in rupees, RBI had to raise rates very sharply at the short end to prevent excessive speculation and to squeeze out the shorts in the market. But this time, I think RBI will mostly do it in a more calibrated manner rather than go in a one hog sharp rate hikes, because they don't the macro is not looking bad enough to warrant such rate hikes. But definitely RBI will have to show that they have intention to squeeze the market, speculative market, by using in short term interest rates if necessary. So they need to send out signals. So that's the reason why market should expect uh, a 50 basis point rate hike in the August policy review. If any of you have any comments, please do reach out to us. You can post it to us directly or through the YouTube channel. Please follow INR Bonds. Let's Talk Bonds in YouTube, Spotify, Apple Podcast, and Amazon. And yeah, thank you for listening in.